Welcome to Joint Mind International Finance Act 2021 webinar, holding today, 11th of January, 2022. I want to recognize the presence of our lead doyen and chairman of Joint Mind International Council, AJM Toby Abiola, MSc, FCTI, FCA. Also recognizing our guest of honor and the 57th president of the Institute of Accountants of Nigeria, Mrs. Comfort Olu Eitayo, MNI, FCA. In the house this morning, we have our distinguished guest speaker, Professor Godwin Oyedokun, PhD, FCTI, FCA, and also seasoned discussants, Mr. Abafolonsho, MSc, FCTI, FCA, Mr. Yemi Soni, MSc, FCTI, FCA. We also have members of the Council of ICANN, CITN, and other professional bodies, as many as are joining us this morning. I'll not fail to recognize members of the Joint Mind International Council. My distinguished professional colleagues. Joint Mind Club was established in 1990 for 32 years, and I've been in the forefront pushing for academic, social, and professional excellence while encouraging, mentoring, and sponsoring students and young accounting graduates to become chartered accountants. This Finance Act webinar is the third in the series of the club's yearly review of Annual Finance Act of the Federal Republic of Nigeria. As we set the pace for this webinar, we'll take off now with the national anthem, and thereafter we'll take the Joint Mind anthem. Welcome, everybody. Joint Mind anthem, please. Can we have the Joint Mind anthem? Thank you very much. Before we go into the full session, I would just like to say that we should all put our questions in the chat box as the session goes on. I want to quickly call on to the chief host, that is in person of the lead doyen and chairman of the Joint Minds International Council, Mr. Toby Abiola, to give us his welcome address. Thank you.
Thank you very much. The moderator, the guest of honor and president of the Institute of Chartered Accountants of Nigeria, Mrs. Comfort Oluwaye. Can you hear me, please?
Yes, we can. Yes. Go ahead, sir.
Okay.
Yes, we can, sir.
Guest of honor and president of the Institute of Chartered Accountants of Nigeria, Mrs. Comfort Oluwaye, Itayo MNI FCA. Our guest speaker, one of us, Professor Godwin Oyedokun, PhD, FCA. Our discussion, Mr. Albert Folonsho, MSc, FCTI, FCA. Mr. Yemi Soni, MSc, FCTI, FCA. Members of Council of both the Institute of Chartered Accountants of Nigeria and the Chartered Institute of Taxation of Nigeria and other professional bodies here present. Members of the Joint Minds International, distinguished professional colleagues, ladies and gentlemen. Let me start by saying that Joint Minds Club was first organized as a final year accounting club at the Federal Polytechnic Ilaro in Ogun State, Nigeria in June 1990. Today, 32 years after, it has become a bounding force for thousands of students and graduates of accounting from Nigerian institutions as well as numerous professional accounting bodies in Nigeria and in diaspora. The club focuses on academic, social, and professional excellence and has been encouraging and mentoring students and young accountants into becoming chartered accountants since its inception 32 years ago. One of the unique features of the club that has contributed immensely to its survival, integration, and growth over the years is its administrative pivot, organized under the 23 family lineage system. Over the years, Joint Minds International has been known to organize various trainings, workshops, seminars on topical finance and accounting-related issues, starting with its professional forum in 1995, where the young club played host to the ICANN Revert Vice President, Mr. Emmanuel Itoya Ajiwere, as guest speaker, and the then Commissioner for Finance, Lagos State, Prince Abiodun Ogunleye. In 2019, with the introduction of the Finance Act as a complement to the annual budget in Nigeria, Joint Minds International has taken up the annual Finance Act seminar as part of its cardinal programs in January every year, the third edition of which is holding today. You will all recall that at the 29th edition of the Club's Finance Act seminar, I, as the lead doyen and chairman of the JM Council, announced the formation of the JM Business Club. This was in response to overwhelming membership inquiries from many quarters, and everything is now set for the acquisition of the pioneer set of the JM Business Club, and the process will be unveiled in the due course of the year. Joint Minds International with total commitment to academic social is the hallmark of it, and I want to thank all of you for attending. And please come and ride with us. Thank you and God bless.
Thank you very much, our lead doyen, for that opening address. Now we'll quickly go to the guest of honor address, and that is in person of Mrs. Comfort Olajumoke Eyitayo MNI FCA, the 57th president of the Institute of Chartered Accountants of Nigeria. We have our address presented online. Thank you.
I am pleased to be part of this webinar on Finance Act 2021, organized by the Joint Minds International JMI. Today's event is not just timely, but the theme is focusing on a very critical and germane subject, the Finance Act 2021. Permit me to reiterate that the objectives of JMI are encouraging, among which is contribution to the development of accountancy students across tertiary institutions in the country. It is also noteworthy that the body aims at inculcating in members the virtues of leadership, discipline, sense of maturity, personal integrity, and responsibility. These are laudable attributes that are central to achieving a society where peace and progress would be the norm than the exception. I admonish the leaders of this body to continue to encourage its members to espouse these virtues in every sphere of life they operate. It is when we collectively entrench accuracy, integrity, and responsibility that we can build a society characterized by inclusive and sustainable growth and development. Ladies and gentlemen, with the current experience of an increasing revenue challenge in the country, it is important that all stakeholders in the economy work with government to address this recurring problem over the years. The Finance Act, introduced with the budget process in the country over 2 years ago, is aimed at developing strategies for shoring up capital for the economy. This is a worthy step that has been taken by government to enhance the income generating potentials of the country. The Finance Act 2021 amended multiple laws such as the Capital Gains Act, Stamp Duties Act, Personal Income Tax Act, Companies Income Tax Act, Tertiary Education Trust Fund Establishment Act, etc. I am confident that this webinar will dwell extensively on the merits and demerits of the Finance Act 2021 and come up with feasible strategies to leveraging the act in taking Nigeria out of its economic woes. Let me add that as we focus on modalities for enhancing revenue generation, the country should also not lose sight of the expenditure side and develop strategies to guide against wasteful and unjustifiable spending. In essence, all stakeholders must continue to advocate for a public sector where value for money would be entrenched and office holders will be held accountable and transparency in public financial management promoted. I am pleased to inform you that our great institute, the Institute of Chartered Accountants of Nigeria, ICAN, is championing the promotion of best practices in public financial management (PFM) in the country. The ICAN Accountability Index, which we call ICAN AI, is the first of its kind tool for assessing public governance practices across the 3 tiers of the Nigerian public sector. I assure you that we would not relent in this public service until the country is returned to the path of transparent and accountable leadership across all tiers. On this note, I thank all of you, both facilitators and participants, for your attention and wish you a very inspiring session. Let me also wish you all a very happy new year. God bless you.
Thank you very much. That's the address from our guest of honor. We shall quickly move forward. The topic before us this morning is Finance Act 2021, Fiscal Imperatives and Sustainable Development. Sometimes in 2021, that's the last day of the year, the President of the Federal Republic of Nigeria signed the Finance Act 2021 into law, together with the 2022 Appropriation Bill. The Finance Act amended 13 laws and has various series of amendments, substitutions, and deletions. And this covers about 39 sections. I would not want to bore you by going into details because the presenter, the guest speaker, will be making doing justice to this, and our discussants are fully ready. They will be looking at the different aspects of the Finance Act amendments and the implications for taxpayers, administrators, and all citizens. Let me quickly call upon our guest speaker, who is going to take us through the real sections and whet our appetite on what to expect in the Finance Act in the next 40 minutes. I'd like to call on our guest speaker, LJM Godwin Oyedokun, PhD, FCTI, FCA, is the HOD Accounting and Finance, Leeds City University, Ibadan, as he come up to make his presentation. While the presentation is going on, please put your questions in the chat box and we shall attend to them as they come in. Thank you very much. Prof, over to you, sir. Hello, Prof, we can't hear you.
Good morning, distinguished ladies and gentlemen. I want to recognize and greet my powerful Hello?
Yeah, we can hear you now. Go ahead, sir.
Okay, good morning once again. My name is Godwin Emmanuel Oyedokun. Actually, I'm not the HOD of the department, but a professor in that department. The leader of our Joint Minds International. Thank you for the opportunity given to me. The chairman of our Family Support Board and System Board. Thank you for the mentoring over time. We have a guest speaker who is actually not a guest, but one of the member of the GMI. And the assignment before us today is to talk through Finance Act 2021 and link it with fiscal imperative and how such can be, aid sustainable development, especially in our country. We will not rush it, and that informed the fact that some of my erudite scholar practitioners will also be discussing this paper with me. Why I will leave them with the nitty-gritty of the cross of the matter, I will try to, in one way or the other, take us through what it is that is matter when we talk about imperatives for fiscal federalism in Nigeria, sustainable development, why we look at Finance Acts generally. Within the space of time given to me, we shall be looking at this in terms of content. I pray time is there for us to justify this. However, the slide and other documents will be made available to all participants as may be approved by the GMI Council. Of course, like Titi Walker said some years ago, that after 30 years of witnessing what we refer to as a Finance Act, 2019 Finance Act surfaced, and it's gained the attention of scholars, practitioners, and tax practitioners for that matter. It is on that subsequently, Nigeria now hope to get more from government, especially when we discover that it has been a kind of a peculiar task for government to obey the rule that says that at least our tax law should not be moribund and should not be too much in the dust before it is being reviewed. And we notice that the Finance Act is now helping us to get some notable amendments that we desire in form of Finance Act. And that has been witnessed with at least the two that are witnessed as a mature professional in the time past. And this is the third one in my youthful generation. I'll also tell us that it is encouraging to see the developing country, especially Nigeria, when we talk about sustainable development and how we are trying to achieve same within the space of taxation. And that's why I have to say that taxation today is not just what we just levy on revenue that have been generated by taxpayer, but it has been used as a kind of instrument to correct. If you look at Adam Smith canon of taxation, you will see that partially we have been trying to modify same and get a kind of tax jurisprudence in that arena. This current Finance Act that we're talking about, that we're reviewing today, amended 13 laws, and it provides a kind of enhanced domestic revenue mobilization instrument that government can use to actually finance the budget as it were. Of course, the task is also to ensure tax administration and legislative driving reform fall in line as demanded. Okay, the Finance Act generally has objective to achieve, and one of such is to promote fiscal equity. And when we talk about fiscal equity, it's not that everybody should get 1 naira as a kind of bonus from government. If I need 2 naira to be at par with people, I should get. If one person will need 3 naira to get at par, that should get. And that's the kind of equity we are preaching, not really that we're talking about everybody should just benefit from government. And while we look at the strategic objective of Finance Act, you will also know that the recent definition of tax has been pushed out with Tax Policy 2017, made it so easier for people to understand the mind of government that, yes, you pay tax, but you may not expect direct benefit from same. That does not mean that direct benefit should not come. And if you look at chapter 2 of our constitution, you will see that most of the things highlighted there are injusticiable because you cannot hold government responsible for them, except where such activities are legislated with the instruments of law, and you can now pinpoint that this is what government should do and how government should do it. Okay, another thing in terms of objective that we have from Finance Act is that it helps government to actually raise revenue that is sufficient for government to prosecute its own business. Of course, we have said it times without number that government does not have any business doing business, because the generality of the well-being of Nigerians is the business of government. However, this issue of revenue generation will help government to prosecute the agenda it has and ensure that merit and goods that cannot just be produced by anyone can be given to the society. We also look at it as a means of supporting MSMEs, and it's also helped to reform domestic tax law so that it can align with what is obtainable in another claims, notwithstanding the fact that at times in trying to benchmark what is available in other claims, Nigeria still try to withdraw, as we see in the this issue of a global minimum tax and the issue of a digital tax that government is trying to say, let us do it in our own way. Another one is that it introduced a kind of incentive that can help the investment population in Nigeria. That is, when tax is used to stimulate investment, of course, it cascades down to improving what we call economic growth. And I need to tell us that economic growth, when it is sustained over time, will lead to economic development. Let me give us some facts, because I know we have been reading on the Facebook, Twitter, if we still have access to that, linking that some major aspect of Finance Acts has been reviewed by others. And basically, I will, for this purpose, recognize the effort of Taiwo Oyedele in being there all the time to quickly dish out and serve as reference point to many of us in this. The stylish fact that I want us to note why I expect the managing consultant of PDABO and managing partner of Yemi Sonny and Co. to also help me out where I may not be able to give details. I'd like to let us know that the name of the act is settled, and it is Finance Act 2020. On no account should professionals of our nature try to make mistake of calling it 2020 Finance Act or 2022 Finance Act. It was signed by the Clerk of National Assembly on December 24, so to say, as we see it on that paper. The President supposedly also signed it on December 31st, 2021, and it has effective date of January 1st, 2022. So which means ignorance of law is not an excuse when it comes to what we have to do with this. Now, I'd like to put this there, and it's just my kind of way of talking. This Finance Act surfaced around 9 to 10 o'clock on January 6th. I stand to be corrected. That is when we see it, and that's why I said that's the day it was released. And it has 34 numbers of pages, and it has 42 sections. Because of the time I have, if you can see, it has 34 pages, 42 sections. So which means 40 minutes I have in this lecture may not be able to permit me to go through one by one. Even if I go one by one, 42 minutes is already gone if I'm taking 1 minute per session, which is not. So I will restrict myself to the important aspect where I allow my senior professional colleagues on the panel to also help us distill some. In all, it has 13 parts. And these 13 parts represent each of the acts amended, so to say. And I've been able to put it in form of table here that we have 1 to 15 on the list. However, 13 happen to be law. 2 other has to do with administrative aspect of it without wasting our time. The statistics is there for us to see. Capital gain tax only saw to 1 amendment, and we shall see. Company income tax has 14. Custom and excise tariff has 1. Federal Land Revenue Service have 5. Personal income tax have 4. Stamp duties have 1, and it is very contentious. Tertiary education trust fund has 2. Value added tax has 3. Insurance Act has 3. Nigerian Police Trust Fund has 1. National Agency for Science and Engineering 1. Finance, Control and Management has 2. Fiscal Responsibility 1. Okay. Then the remaining section has to do with the effective date and citation of the law. Okay. If you look at it one after the other, and I'm riding on the shoulder of those that have reviewed it before, especially Taiwo Oyedele, to really recognize and appreciate him on this, because it makes some of our works to be easier. Okay. We have those at a glance in terms of, and if you look at it, I used to tell us that when we talk about tax law may not be only those laws that has tax in their names, but those other laws.
Sorry, please, sorry, Prof. Dare Adepoju, please stop annotating the screen. Okay, continue, Prof.
Thank you, madam. Okay, so there's some other laws that has provisions for taxation that we need to also recognize, and that's informed why some other laws are being done here. Let's quickly, Dare, please, whoever is doing this, you please recognize that we are many on this platform, and we have about 823 as of now. Please let the screen be as clean as possible to aid our conceptual understanding of what we are doing. Okay, the capital gain tax here is just about the rate that was said to be 5%, and it's applicable to when you dispose your share in Nigeria, and the share price value is around 500 million, and it's within 12 months. What you are supposed to do is to note that where the proceed is not reinvested fully, the aspects of that amount that you are not reinvesting will be subject to tax. And if you transfer it under regulated security, the law under RSLT will also apply. But when we look at company income tax, which I'm still going to come back to within the space of time that I have, you will notice that ever since we've been having Finance Act, company income tax has been the one that always have lion's share, maybe because of the fact that it concerns a lot of activities that improve ease of doing business. We have that provision that talks about lottery and gaming operation. We have that aspect that also talk about minimum tax, which is now applicable on kind of a 0.25 instead of 0.5% that we used to have. And but we need to know that it's applicable only within the two accounting period, 2019 and 2020. And there are some intricacy of this that if you have not filed your returns, you may wish to key into these. And please, we also need to ensure that we are very clever when we are doing this. And within the space of company income tax that we're talking about, we know that formerly companies with downstream operation were eligible for exemption of their profits when they have qualifying goods exported from Nigeria. But look at the three trees that I put there. When we look at companies operating in both mainstream and the downstream sector, they are no longer eligible for such exemption. It means they are now captured back into TaxNet. The incentive for gas utilization is also now to be claimed once by an entity. When we look at the restructured entity that already claimed the credit before restructuring, they can no longer come back to that. And the capital allowance aspect of it is to be claimed on assets. And you should now know that it's limited to profit of that set used to generate taxable profit. What the act is trying to say now is that before, if I have Namina You and Company and I have various assets, and I look at the principle of QEC, qualified capital, QCE, qualified capital expenditure, I can just apply to the minister in charge, which is trade and investment, and claim that I have capital, qualified capital expenditure, and I get certificate, then I utilize it. But now, what the act is saying is that you should be able to identify which part of your capital expenditure is used to generate what profit. Now, accountants, you've been hearing that a digital world will take over your work. And I used to say, no, it cannot. This is where you'll be relevant, because you'll be needed at all time to separate, to distill, and to work this out. So computer will not do this for you, but you will have to initiate computer to help you do this. Okay. When we talk about capital allowance brought forward by an SME, which is now treated as having been claimed and consumed in each year of assessment, what happens is that exemption is granted where the company has pioneer status, and value-added tax really do not have much problem. But what the act here has done is to let us know that the companies with less than 25 million turnover are excluded from VAT compliance. And the precursor to this is that when the Finance Act 2019 and 2020 came on board, we were agitating that, yes, you said companies has been integrated into its minimum and the largeness of it, and it has three different rates. They're rated 25 and 30% as SITA. But if you exempt me from paying VAT by the virtue of the size of my company, will I still need to fulfill righteousness of filling form, nil returns, and the like? This particular aspect has laid it to rest. However, created another problem, which is on non-resident entity when it comes to the supply of vatable goods and services in Nigeria. What it is now said is that there's an obligation which was resided in one party before. It has now shifted to Nigerian counterparts. That is, non-resident companies should register for tax purposes and they should remit. But in case they do not do that, that company that represents them in our country has the obligation to ensure it is done, and such will be traced to them. And then again, accountants, we have a lot of work to do, and we shall continue to do that. So we must understand this so as to give adequate professional advice when it is needed. And when we talk about education tax, it's not as if we have much there, but what the act is saying is that the issue of when it comes to when you oppose, you have 60 days to do XYZ, in order to help tax jurisprudence and appeal processes, this has been reduced to 30 days. So if you are reading old text, old information about this, that you can do all this within 60 days, please, we have to quickly amend that and have it done. The issue of electronic money transfer levy has generated a lot of issue, especially when it comes to issue of stamp duty, especially when it comes to who is to even administer, which is not the purpose of this electronic money transfer, but has generated issue because of the interest that has been invested in some agency of government. So it is not clear that the Finance Act 2020 is saying compulsorily Minister for Finance shall make regulation for both administration and collection, then enforcement of EMTL and further provision affecting anything that has to do with stamp duty, especially when it's from 2015 to 2019. This I'm going to treat under a separate heading, under controversy, that Finance Act 2021 has been able to generate. However, let me quickly tell us that how do we think it will be possible to look back to 2015 and 19 in terms of accounting and the likes? Of course, accountant, professional accountant, we have a role to play here, and we need to play it with all sense of responsibility. Come to the laws that were identified by Finance Act 2021. When it comes to the amendment is National Agency for Science and Engineering Infrastructure Act. There is one aspect of it that require commercial company to pay 0.25% of their turnover to this fund. This time around, the law is now looking good by exempting the likes of my own company, which is trying to come up not to pay. And specifically, the money to be paid here will now be for those that are in ICT related. And the administration of all taxes collected by, that is federally collected, let me use that word, will now be handled by Federal Revenue Service, and that want to do that and is to collect and enforce the payment of same. Withholding tax, Samuel Ojuola, you can do without touching your screen. The withholding tax received on a unit trust.
Continue, please.
Okay, thank you. The withholding tax received on a unit trust shall be final tax on that interest. For those of us that are managing such, we need to be very conversant of that. And the Federal Revenue Service has the power to assess digital companies that are involved in e-commerce, mobile. So far, they can be attributed that they generate or supply same in Nigeria. And this is going to be another source of jurisprudence as to how will this be possible. But one of the documents I read over time indicates that even other jurisdictions where such taxes are in existence, it is difficult for such tax jurisdiction to get those taxes out from them. Other highlights that we have has to do with the disputed tax assessment to be in abeyance on the determination why undisputed tax assessment is to be paid within 30 days. If you recall, there is this issue that happened within the last 4 months or 5, where Tax Appeal Tribunal was trying to say, if you are in dispute, you need to pay so amount within the space of your tax disputed something. The Finance Act is very clear now, and reference to professional tax has been deleted completely now. The issue of deployment of technology to automate tax administration is also gaining momentum, and FRS is now empowered to deploy such and also use third party to do that on behalf of the country in order to ensure we generate appropriately. The issue of primary agency for the federal government in terms of administration of an assessment and collection of and accounting for taxes is now laid to rest, as FRS is to be the primary agency. And we just pray that they will be able to continue to cope. Is one of my advocates that it can be done, notwithstanding my mind when it comes to division of taxing power. Well, another point there is that any person or agency of federal government in that arena must refer matters requiring tax when it comes to investigation, enforcement to Federal Land Revenue Service. And I think this will also interest TT for Okon, as before we used to notice that at times some overbearing staff of tax authorities will serve you letter that they want to come and audit your withholding tax. Another part of that agency will still send a letter to you. They want to come and audit your VAT. I think this is now going to be harmonized, and so far the same book can be used to answer this. PDABO will be able to help us shed more light on that. Section 4 of Nigerian Police Trust Fund that I said the other time has been amended, and a new subsection was created, and it has to do with the issue of FRS to assess, like I said previously in the highlights, that even the Police Trust Fund is being kept in abeyance because of the fact that the administrative arms of it were not really on board. But now it is clear that FRS will be in charge of the assessment, collection, accounting, and enforcement of these payments. Well, the provision of the company income tax on this is now very clear, and the FRS Act shall apply to this administration. So there's another amendment on Fiscal Responsibility Act, and this one, to me, for want of saying unnecessary thing on public fora, is another means by which those charged with authorities are trying to justify and legalize what they have in mind. But we should not see it only from that side. We should see it from what it will profit the nation. So whereby government can only borrow money to prosecute some capital expenditure, and now it's been enlarged and expanded to human capital development, and the capital expenditure has also been defined as spending on assets that last for more than one financial year. Like some of the commentators on this have said within the last few days, I have phone. My phone can last more than 3 years if I maintain it very well. Okay, can this qualify as capital expenditure government of our country should borrow for? Okay, that is that on the generality of what it is, and I've been able to also extract those acts one by one, making reference to the section of the tax, which will not be so important for me to go back to because of my time, but I've been able to distill it to help us generally. So what we will do now is to look at most controversial aspect of this Finance Act. And I beg us to take our mind to what is on the slide and go through and see the mind of the drafter of this analysis by saying,
Sorry, Prof.
Yes,
permit me to just tell you that we have about 5 minutes for your session. So
yes, I am aware of that. Thank you, Ma. So the agitator is saying, when you take away the power that Constitution should exercise over a particular issue, and you arrogate it to a lesser authority within the confine, then it means you are conflicting with this Constitution. And the matter was put up and it's been circulated. And we try to get comments from other experts. And what we have now is that we should let it be for now. And when it gets to where the minister in charge will be able to legislate by giving us regulation, which is futuristic in nature, we will now see what it is. And the case of this issue of taxes and approved list for collection is very, very, very fresh in mind. Okay, another one is on the issue of 10 naira per liter of carbonized drinks, which we call sin tax, is also gaining momentum. I'm not ignorant of the fact that all of us must have read about it. Manufacturers Association of Nigeria has talked extensively on that, and the issue therein should be in our mind, not because you need to fight government, it's just for you to be able to advise your clients or your company appropriately. In all, fiscal imperative is key. What it is that we want to use taxation to achieve. Whenever government is trying to tamper with law, review law, we should have in mind what we want to achieve. And we should not forget this issue of sustainable development, how we can use Finance Act to achieve same. And in that manner, I like to conclude that like other two previous Finance Acts, this one is also a welcome development. It has touched on some of the aspects of taxes that were agitating our mind. There is always a room for improvement. And I want to tell us that notwithstanding the accolade that we have given to this Finance Act, I want to put it on record to your distinguished excellency here present, over 978 participants, that one can agree that it is apt to see our tax and related law being amended as necessary. But caution should not be thrown into gutter when fiscal policies are being reduced to law. Because of this issue of going concern of taxpayers, we should not activate the issue of tax to debt and bring it as a culture in Nigeria, where we are trying to ensure that we prosecute deficit budget with tax income or tax revenue generated. We should also be mindful of the fact that the only set of people that are complying with whatever the minute tax pronouncement will also be the one that will be bearing the brunt of increase in taxes. And I'll continue to say distinguished ladies and gentlemen, that when economic is shrink, disposable income is not there. And if you now want to tax again the little disposable income we have, it means you are shrinking taxpayers to death. They will not be able to do. And of course, when it comes to dog that is very hungry, you cannot, or you may not wish to also tie that dog down. I've made some recommendations that we need to look at, that government should observe with all sincerity the basis for division of taxing power, whereby the tiers of government will be able to also get fair sharing of what the taxing power they have. Distinguished ladies and gentlemen, the doyen of GMI, Family Support System Board Chairman, moderator, and my co-panelists, this is the convenient place to say thank you for listening, while I will stay on the panel to answer some questions that may be directed to me. Thank you so much.
Thank you very much, Professor Godwin Oyedokun, for that detailed presentation. I've been seeing comments from the participants about as we were going along. If I may just say that you have taken us through the Finance Act in the past 40 minutes, talking about the solid facts, talking about the amendments, the CGT issues, the CIT issues, the VAT issues, the NASENI tax, police trust fund, payment, no more excuse for remit. Everybody needs to remit what provisions are made. Taxpayers will now have to allow deployment within 30 days of notice, but we need to also exercise caution in respect of our trade secrets and cyber threats. There's also controversial issues that have been discussed in terms of the 10 naira per liter, in terms of coordinating controlling our consumption of sugar, and the stamp duty admin issues. We've taken this, quite a lot of issues have been flagged in this. Before we go into the other presenters, I would want to quickly recognize the presence of some of our dignitaries on our participation this morning. I would like to recognize the presence of Alhaji Kingsley Segosime and Chief DCS Alaribe. They are both council members of ICANN. We recognize your presence. On the list, I saw the executive chairman of LIRS, Mr. Adele Subar. We recognize your presence. And I think I saw other distinguished SWAN members, Mrs. Ozekwego, Ms. Felicia Bangboye. So we recognize your presence. Thank you for being on this webinar. Without wasting our time, so we can have enough time for questions, I'd like to quickly go to the first discussant on this panel, in the person of Mr. Abba Folorunsho, FCTI, FCA, Managing Consultant, PEDABO, to give us his thoughts, looking at the specific aspects of the Finance Act 2021 and telling us his own views about how this will make our life better as citizens, Nigerians, taxpayers, and also the work that is ahead of tax administrators, tax consultants, accountants in the house, and for us to know what we are in for. Thank you. Mr. Folorunsho, please.
Good morning, ladies and gentlemen. I'd like to stand on the existing protocol, which has been duly established by Professor Oyedokun. My sister, thank you, Dr. Siti. How much time do I have? Because you want me to give...
Okay, sorry, sir. We are giving you 10 to 15 minutes, sir. If you can do 10 minutes, we wouldn't mind, so that our participants can ask questions. I've been seeing questions flooding the chat room.
Okay, so which means I may have to be a bit fast. I hope
yes.
you're here with me.
Thank you, sir.
So Prof has already given us the global view on the Finance Act. So I'll probably just jump into specific and some of the issues that I think we will need to address as professionals, some of the things that will be accosted across the streets and will be required to comment here and there. And of course, the first one on the list is again the the capital gains tax, which has been amended briefly, particularly as it relates to disposal of shares. Of course, we know that disposal of shares was exempted effective 1998 for the past 23 years, but this is just a gradual rollback because not many other countries actually exempt gain on sale of shares from tax. But what do we have now? The provision is to the extent that which more or less focus on big players, which means not everybody that goes to the market and buys shares that will be affected by this amendment. And it says that you will, I noticed that the PROS was still making reference to what was in the original bill, but the bill has become act and several changes have been made. So the threshold for you to be liable to capital gains tax on your disposal of shares now has been reduced to 100 million. So, which means your accumulated acquisition within a year, if it is 100 million and above, then you have triggered capital gains tax on your shares. And so the next question, how will it be calculated? First is to ascertain what you have acquired, disposed during the year, which means it will be an accumulated disposal in terms of different portfolio that you may have. We'll look at the aggregate and see how much was disposed during the year, okay? And then of course, when you talk about during the year, even though the law says 12 consecutive months, the way it is, it appears to me that it will be better to apply it on an accounting year basis. I mean, on a financial year basis, which is January to December, okay? And so which means for 2022, whatever you dispose during 2022 will be ascertained, and then the gain will be determined. But of course, we have the rate remains 10%, like any other. The normal rate for capital gains tax, which refer from 1996 actually. So the rate has been reduced to 10%, and that is the rate that has also been sustained for shares. Another point we need to note is that where you make the investment during the year, okay, and at the end of the day, we are looking at the net disposal, okay, before you can be subjected to CGT, which means if there is rollover relief, okay, the gain on the amount rolled over will not be liable to CGT. If there is partial rollover, which means the amount you dispose, you did not fully reinvest everything. The portion that is not fully reinvested will be liable to CGT. Another point we need to ascertain is the fact that under capital gains tax, you know, we used to have classes of assets. So we can now take shares as a new class of asset eligible for rollover relief. And then in terms of a time limit, the original provision in the CGTR says that acquisition 12 months before and 12 months after the disposal of the asset. But in this case, it is only restricted to acquisition and disposal within a 12-month period. And I think we need to take note of that. Luckily for us, there are exemptions that particularly apply to government securities, bonds, treasury bill, treasury certificate. So if you continue to invest in those instruments, the capital gains tax on shares will not be applicable. Okay, so we need to also take note of that. So what are the things we need to really concern ourselves as professionals? You need to liaise with your clients. If you have stockbroker as clients, we know the schedule to the Capital Gains Tax Act, okay, actually empower, you know, the tax authority to appoint agents for the purpose of collection of tax and for filing of return. So the tax authority may, you know, appoint the stockbrokers who have been representing the investor to really account, because it will be difficult, particularly for individuals which are supposed to pay their CGT on shares to the state. It will be difficult for any state internal revenue to start pursuing individuals across the street. So their focus will be on the stockbrokers who represent them. And so stockbrokers have a lot of work to do. They must keep portfolio of their of their investors or that invest through them. And then, of course, the bucket of portfolio will now be the one to be reviewed to ascertain how much gain the person has made, during the year, and to determine whether the person has triggered the threshold of 100 million, which is the new threshold for you to be liable. So those are areas that we would need to concern ourselves. Again, the last point on this is the fact that the sunset provision that exempts income and gains on government bond, treasury bill, corporate bonds, has expired. And even though they will not be liable to capital gains tax now, but the income are liable to tax. And so withholding tax may become an obligation, even for CBN or for debt management office who are responsible for government securities. These are an area that also have to be looked at. I will move quickly to company income tax, and I'm going to be very fast on that again. The first provision, I will just speak a few of them that I think are more significant. The first one I will speak about is the one on educational institutions. I think that is very critical. Educational institutions, it is neither here nor there yet. Section 23, subsection 1C, that provides or that's used to exempt income of educational, ecclesiastical, and any institution of a public character. Okay, that provision has been amended briefly, and the word educational has been removed. So what is the implication? Does it mean that all educational institutions, whether of public character or private character, as the case may be, are now liable to tax? I do not think so, even though others have opinion. If you are an educational institution set up either under a trust deed or you're under a company that is limited by guarantee, and what that means is that the promoters, the owners, or the people that oversee the business are really not taking profit, okay? They should not be liable to tax. We will see how that unfolds in the very near future. Again, let me go quickly to the issue around the turnover tax. Section 30 was amended, subsection 2, Roman figure 2, to include non-resident companies, and of course, we know the provision of Section 30 is to the effect that where a company's accessible profit cannot be readily determined, or where their accessible profit declared is, below what is expected, the tax authority may assess such a company to tax on turnover basis on a fair and reasonable percentage as they deem fit. Okay, so that provision has been extended to non-resident entities that are engaged in digital activity in Nigeria. Okay, those that are engaged in digital activity of online business, electronic commerce, electromagnetic platform, cable and radio, all of those non-resident locations are now to be assessed, are now to be open to being assessed on turnover basis. But of course, for that to be applicable, the company must not have complied with the existing provision, which means if you are a non-resident entity, and you have a significant economic presence in Nigeria, the law requires you to file your return and pay tax based on that return. It is only where you fail to file such return or the return is unacceptable to the tax authority that they may consider applying the Section 30. And so it is very clear that it is not that Nigeria has adopted what is called DST, Digital Service Tax, that is applicable in some other jurisdiction where non-resident entities are subjected to a flat rate on their turnover, like we have in Kenya, 1.5%, in Italy, 3%. Nigeria has not adopted that. Non-resident entities are still expected to file their returns, and on the basis of the return, they will be made to pay tax. Okay, so I think that is another message we need to pass across. Now, let me go to the issue around capital allowance. Now, the amendment to capital allowance restriction has to do with what was made to Section 28, Section 27 on expenses that are related to exempt income. Okay, we know that in the 2020-2019 Finance Act, one of them, where you incur expenses that can be assumed or related to income that is not liable to tax, the law says that such expense should not be allowed. So this extension now has to do with assets that are being used in generating exempt income. And of course, the National Assembly, the minister has couched it in such a way that they know that not many of those exempt income really use assets. And that is why they have said this will only be relevant where you have exempt income to the extent of 20% of your total income. Okay, if the exempt income such as dividend, which is treated as frank investment income, interest on treasury bill, interest on bond, and some of them are even no longer going to be relevant with the expiration of the sunset provision. Okay, but that provision now is there to say that when you have exempt income, we also have to ascertain a portion, particularly where the exempt income is above 20%. We need to ascertain the capital allowance portion of that exempt income and exclude it from what you can use to reduce the income that are taxable. Okay, so the details can also be looked at. The same provision has also been extended to small companies, small and medium-sized companies whose tax rates have been reduced. We know that for small companies with turnover of 25 million and below, they are now exempted from tax at 0%. So what it means is that you will still compute your tax. You will still absorb your capital allowance to the extent of your assessable profit. And then whatever is left, after ascertaining your assessable profit, it is assumed that your assessable profit will be used to reduce your capital allowance, so that when you now have a turnover that has taken you to either the medium scale or the large scale, you will only carry forward the unabsorbed capital allowance after you have after you have jumped out of that threshold. So we should be able to marry that same provision with that. Then quickly on VAT. Now, recently we know that the FRS issued a circular as to how non-resident companies will be appointed as agents of the Federal Inland Revenue Service for the purpose of collecting VAT on cross-border transactions. That has now been incorporated into the law to the extent that for foreign entities that are also engaged in digital transaction in Nigeria, they are to be appointed like Zoom, Twitter, Amazon. All of those are non-resident entities. The Federal Revenue has appointed them, okay, and the law has said they should be appointed as agent of the Federal Revenue Service, such that when you transact business on their platform, it is their responsibility as non-resident entity to charge you VAT and to also remit the VAT element of the invoice to the Federal Inland Revenue Service, which means the old provision, which has not been removed, particularly for business-to-business transactions, where Nigerian residents had the responsibility to withhold VAT on transactions they have with a foreign entity before making payment. Okay, it is now a dual responsibility, more or less. FRS is Federal Revenue Service is just trying to be sure that any which way no element of tax is missing. So where the Nigerian company that has transaction with the foreign company fail to withhold the VAT and remit to FRS, it is the responsibility of the foreign entity who may have been appointed as agent to remit the VAT to the Federal Revenue Service. So it is not that the old provision has been removed, particularly B2B transaction. But when it comes to B2C, and business to consumer buying books on Amazon online, not many of us will be tracked. And so it is the responsibility of the non-resident company to register and deduct the VAT and remit to the Federal Inland Revenue Service. Then again, on stamp duty, there has been argument as to what really is the responsibility of the minister in issuing guidelines on collection and distribution. That provision is specific to those that have been deducted and are in the coffers of the CBN from 2016 to date. And what the provision says is that within 30 days of signing into law, the amount that has been accumulated must be distributed. And of course, we already know that in the 2020 Finance Act, the distribution formula is 85% to the state and 50% to the Federal Inland Revenue Service. So that provision is just saying that that must be done, and minister must immediately, in agreement with the National Assembly, give guidelines on how that distribution should be made. And that going forward, subsequently, it is the responsibility of government to ensure that whatever is accumulated, whatever is collected on a monthly basis, as far as stamp duty, I mean, not stamp duty now, electronic money transfer levy, as far as electronic money transfer levy is concerned, must be distributed on a monthly basis.
I'll give you 5 minutes more, sir.
Okay, thank you very much.
Is that okay for you, sir?
5 minutes, yeah, that's fine.
Okay, yeah.
Okay, so let me touch briefly on going back to CETA now, section 33, that has to do with minimum tax. We have had that controversy as to when exactly is the effective period for the reduction in the minimum tax rate from 0.5% to 0.25%. And the misconception came from, or the misunderstanding, not really, the error came from the last Finance Act. And that has now been corrected, and to the extent that you don't claim more than 2 years reduction, which means either on your 2019 account and 2020 account. If you are taking 2019, automatically you have to take 2020 account, okay? And then that reduction of 0.25 will be applied on those two accounting periods. But if you have not taken 2019, it means automatically you are taking 2020 and 2021. Of course, so many companies have done a review of their transaction before the end of the year 2021. And if really your turnover has increased, in 2021, particularly coming from a pandemic period, even though we're still in it, but of course, things are settling and several companies' turnover increased. Definitely, you want to take the advantage on 2020 and 2021 account, 0.25% of your turnover. And I think FRS was also introduced some penalty so that if you have failed to file your returns as at when due and you want to take that advantage, you will be liable to pay that particular penalty. Again, on the FRS Establishment Act, 2 significant provisions was made in this Finance Act. One has to do with deployment of technology. In the 2020 Finance Act, the law says that you can only deploy proprietary technology, which means in-house developed technology. But of course, we know that FRS is not a technology company, and therefore it will do well for them if they can engage third parties to help develop the appropriate technology that they will deploy to be able to do their business of collecting tax and administration properly. So this 2021 Finance Act has given them that power to deploy third-party technology as they deem fit, as long as they give notice to the taxpayer. And if the taxpayer objects, they need to look at it objectively and see why they have objected, and probably give an extension of time, or look at their business and see whether really the technology is critical to them. If not, that should now be something that they can engage taxpayer on. The second significant provision is the one that has given FRS the precedence when it comes to collection of revenue for federal government, and that is why we can see that the police trust fund has now been given to them. The Naseni Act has given them the power to also collect on behalf of federal government. So they have the precedence now over other authorities and other regulatory arm that's attempted or have been attempting or have been trying to encroach into the space of the Federal Revenue Service. I don't want to mention their name again, but they know themselves, and they have been engaged. They have been, enjoyed to liaise with FRS. So if FRS require the service of any of those regulatory authorities, particularly EFCC, there's no reason why FRS cannot liaise with them. But it is not for them to take the lead role, and it is not for them to collect and pay into an account that FRS cannot issue receipts. That has happened in the past, and by this provision now, it has become criminal, liable to a fine of 10 million and imprisonment for 5 years for any officer that attempted to encroach on the activity or on the ability of FRS to carry out their function properly. When it comes to personal income tax, we only have the provision that says that only life policy, when you insure your life or the life of your spouse, you can only claim the personal relief on that premium. Okay, it no longer extends to annuity payment. A lot of us do investment and say we're insuring our life. No, the law has said that anything outside life policy, the contribution or the premium will not be acceptable as a relief. Another thing that has been amended again under personal income tax, which has also been replicated in the FRS Establishment Act, is this requirement for taxpayers to, or banks, sorry, for banks to file returns of new customers, okay, with the bank on monthly basis. Now the law says you should file it on quarterly basis, and where you fail as a bank to file those returns on quarterly basis, a penalty of 1 million naira will be levied on quarterly returns. Okay, some states, particularly Imo, attempted to, or have even started levying on, maybe some even attempted to base it on the number of customers, while some have attempted branch by branch. But the law has clarified that, and it is 1 million per quarter per bank where you fail to file returns, 1 million for FRS, and 1 million for the state where you fail to file those returns. Let's hope that we can have some certainty on that.
Your 5 minutes is sir. I don't know if you have
no,
still have so much. Okay. Yes.
I just round up. In rounding up, I will mention the increase in education tax from 2% of accessible profit to now 2.5% of accessible profit. That is pretty straightforward. And again, the Naseni Act, which I have mentioned earlier, the Naseni Act, which has to do with National Agency for Science and Engineering Infrastructure Act, now require companies with turnover of 100 million to pay 0.25%, 0.25% of their profit before tax to the Federal Revenue Service, who has also been mandated to collect the Naseni levy from companies. And of course, the companies must be in either in the following industry. We have banks, mobile telecommunication, ICT, aviation, maritime, and oil and gas. Okay, anything outside that, just like we have for NIFDA. So the question is, why do we have NIFDA? What is the difference between the Naseni Act and the NIFDA Act? Well, that is the provision that we have to deal with for now. Those are the issues I like to touch on, and then we'll sit back and wait. I don't want to talk about the sin tax because the 10 naira per liter on non-alcoholic carbonated sweetened beverages is already controversial enough. So I will just let it. Thank you for listening.
Okay, thank you very, very much. I think you really, really shed more light on the presentation that we have. Just for us to, we'll put all the questions to after the presentation and discussion. I would like to just bring on board now Mr. Yemi Sonny, a friend, a brother, a council member of Chartered Institute of Tradition of Nigeria, and also the managing partner of Yemi Sonny and Co. to come on and give us his own intervention in relation to the Finance Act 2021. I know he's going to be looking at it more holistically, and at the end of the day, I hope questions will start flooding in once we hear from him. Thank you very much. You're welcome, Mr. Yemi Sonny.
All right, thank you, Dr. Titi, for welcome. Let me first of all thank Joint Minds International for finding me worthy to be a discussant on this paper here today. I would like to, for the want of time, I would like to, I'm sitting down, sit on the existing protocol that has been established by Professor Godwin Oyedepo and Dr. Titi for welcome, as well as my senior brother, that Mr. Bafo Lawrence, so that we can get to the matter immediately. Professor Godwin Oyedokun gave us a synoptic account of the key changes in the Finance Act 2021. So in order not to bore us further, to bore us much and not to deliberate on the issues that have been really discussed, I'll be talking more on those areas that have not been touched and the ones that have been touched but have not been talked in depth. On the basis of these, I'll be looking at about 6 areas. And that will be the Federal Inland Revenue Service Establishment Act 2007, the Personal Income Tax Act, the Insurance Act, the Nigerian Police Trust Fund Establishment Act, the NASENI Act, as well as the Stamp Duty Act. For the purpose of all of us that are watching today and that have joined us in this seminar, of course, I'm sure we are here to put our pantomimic heads together and have a grip and a firm understanding of what we have in the Finance Act 2021. Professor Godwin did some highlights, and I'll just bring it to bear to us. In the Federal Inland Revenue Service Establishment Act, there are 5 changes, key changes there in the new Finance Act. And the changes are in Section 25, Section 28, Section 35, Section 50, and in Section 68. I'll be dealing with this one by one after this. In the Personal Income Tax Act, there are 4 key changes, and that is Section 33, Section 47, Section 49, and Section 94. In the Insurance Act, there are 3 changes. You have the Section 9, Section 10, subsection 3, as well as Section 102. Then in the Nigerian Police Trust Fund Establishment Act, there's only 1 change in the Finance Act, and that is in Section 4. In the NASENI Act, that's the National Agency for Science and Engineering Act, there's only 1 change as well, and that is in Section 20, I guess. Then in the Stamp Duty Act, that is in Section 89A. So I'm going to take them in succession. I'm going to start with the Federal Inland Revenue Service Establishment Act. The first of the key change there, the first change there is in Section 25. And if you're looking at the original Federal Inland Revenue Service Establishment Act of 2007, in Section 25, there are only 2 sections. So you'll be wondering, oh, why are they substituting Section 4 from? So you need to understand that in Finance Act 2020, they introduced 2 new sections into the Federal Inland Revenue Service Establishment Act. So that made Section 25 to have 4 sections. And that is what the Finance Act 2021 decided to deal with and now talk about. So one of those key things that was changed in there in Section 25 is the right to deploy third-party, the proprietary of third-party technology to companies. And why do they want to do this? They want to do this because of some of the transaction taxes that we have. They want to do this so that they can get at source the total transaction done by these companies and to be able to know the tax due there, you understand? So that is what the Section 25 aim to do. And the next one, because they now establish another section, which is Section 4A, which is inserted. That is the FRS, when you want to, the FRS will notify the companies that, okay, they want to deploy. But if they want to deploy, of course, the company has the right to ask for, because it's within 30 days that you're supposed to agree or just attend to FRS notice. So the taxpayer has the right to ask for an extension of the time that the proprietary or the third-party technology will be deployed. And the FRS in this Finance Act has the right to be able to extend or to decide to jettison that idea. Also in Section 4B, they extended the Finance Act put there that in a situation where a taxpayer rejects or fail to comply with that provision, which is to accept or to allow the Federal Inland Revenue Service to deploy the appropriate technology, of course, a penalty will be imposed on such a taxpayer. And the penalty is going to be 50,000 plus 25,000 naira for every day that that taxpayer failed to allow the FRS to install that proprietary information. That's on Section 25. So on Section 28, Mr. Bafolonsho already dealt on that. That is where they were talking on penalty for non-filing for banks in Nigeria. Apparently, banks are mandated to file returns, quarterly returns with to file quarterly returns or to send returns to the State Internal Revenue Service for individuals that open account have transactions of 5 million and for corporate bodies that have transactions of 10 million. And what is this supposed to do? It's supposed to help the State Internal Revenue Service to be able to profile taxpayers, because when you know the transaction, you know the volume of transaction they do, when they file returns, in terms of their returns, you know whether, of course, they are underpaying their taxes or not. So this made provision for that. Also, Section 50 of the Federal Inland Revenue Service Establishment Act made it mandatory because the staff of FIRS, they are proprietary to information, taxpayer sensitive information. So, and they're meant to make it confidential. They can't share this information with just anybody except maybe the court or probably the police when there's an investigation that is going on. Also, Section 68 talks about the inconsistencies in tax laws. What the Finance Act says now is that where there are inconsistencies in other tax laws, like the CETA, the PITA, the Stamp Duty Act, the Value-Added Tax Act, that the Section 68 says the provision of the Federal Inland Revenue Service Establishment Act will prevail over this. My question is this. The other acts that I just mentioned, they are provision of the Constitution. And because we know that anything in the Constitution, is, takes precedence over any other law. So the question is, will taxpayers not challenge this position? Because if they are saying there is inconsistency, and they said to the extent to which there is inconsistency, those inconsistencies will remain void, and the Federal Inland Establishment Act will take precedence over that, and that is, yet to be tested in court. Then also, Section 68, subsection 2 makes FIRS the sole administrator of federal taxes in Nigeria. So now, all taxes that is to accrue, all payment that is to accrue to the coffers of government, FIRS have been mandated to be the sole, so one of these is, we'll see that there was a time NIPOS and FIRS were fighting on who is to collect stamp duty or who is not to collect. This has put to rest that the power to collect such taxes rests with the Federal Inland Revenue Service. Then again, there's another section there, that's subsection 68, subsection 3. What he has done is that he has prohibited any federal agency from collecting taxes apart from the Federal Inland Revenue Service. What readily comes to mind here? You and I both know that we have, like what I just said now, NIPOS wanting to collect stamp duty. Another one that, people that are in the field, people that are tax practitioners have really seen over time is RAMFAC. Apparently, after maybe the State Internal Revenue Service has carried out an audit, Federal Inland Revenue Service has carried out an audit, you find out RAMFAC will come to say they are carrying out an audit on companies as well. And the liability is so established, they will give an account where to pay the money to, which is not even an account provided by the Federal Inland Revenue Service. So this has put to rest that, you understand? So RAMFAC and all other bodies don't have the right to come. Then again, the Finance Act talked about the right to work with ministries and departments. Ordinarily, most ministries and departments, the government believes that there are a lot of leakages in taxes they can get from there. So as a result of that, this act deals with Federal Inland Revenue Service being able to work with the federal ministries, departments, and agencies to ensure that they minimize tax revenue loss. Then again, something came up on right to report a case of investigation, which is in Section 8, subsection 5, which makes gives anybody the right to be able to come up with if there's any issue you believe that, okay, warrants tax investigation, of course, you can bring it up to bear so that can be addressed. So that addresses the key changes in the Federal Land Revenue Service Establishment Act. So we shall be looking at the other changes we have in the Personal Income Tax Act, which are the 4 changes I talked about, which are in Section 33.
Dr. Sonny,
yes, sir.
Please, we have like 5 minutes for you, so we can go into question and answer.
Okay, there's no problem. Yeah, so I'll quickly treat the minimum. So which are in Section 33, 47, 49, and 94. And what are the things that this says? Now, what the Finance Act has said is that insurance premium paid on oneself and one spouse shall be an allowed deduction for the purpose of computing tax for an individual, except for contract of deferred annuity. Deferred annuity used to be in the previous Finance Act, but they have excluded it now as an allowable deduction. So that is very, very clear on that. And again, there's penalty for non-filing of individual banks in Nigeria when they are requested by the State Internal Revenue Service. So because when State Internal Revenue Service requests for documentation of individuals that have account with the bank, they are meant to respond within 7 days. And if they don't respond, of course, the law is there to ensure that there's penalty to be paid. Also on the Naseni Act, what has happened is that on the Naseni Act, now, the Finance Act is clear on who is to collect the new levy that they have levied there, which is 0.25% of the profit before tax. Before, of course, anybody will have thought that it will be collected by the ministry that necessarily belongs to, but now the law has made it clear that it's Federal Land Revenue Service that is to collect that money. And those people that are to be levied are people in aviation, banking, telecoms, oil and gas. And those are people that have a turnover of 100 million and above. And also on the stamp duty. What the Finance Act 2021 has done on the Stamp Duty Act is that the imbroglio that was between the State Internal Revenue Service and the State Internal Revenue Service and the Attorney General of the Federation on non-remittance of the back duty investigation on stamp duty has been laid to rest here, wherein, of course, that issue was dealt with by Mr. Albert Folorunshor in his discussion. So that has been made clear. And in terms of electronic money collection, of course, the same act has made sure that it's Federal Land Revenue Service that can collect that. And once that money is collected, of course, it must be distributed within 30 days following the date that collection has been made. I think that deals majorly with that. Then the last one is the Insurance Act. There are 3 changes in the Insurance Act, which Section 9, Section 10, Subsection 3, and Section 102. What that has done is just changes there has been to change the term paid up capital to capital requirements in Section 9 and Section 10, Subsection 3. So, and the Section 102, which is the 3rd change, now define capital requirement. And capital requirement has 2 definitions. Add definition as regards existing company or as regards a new company. For a new company, of course, capital requirement is defined as the government bonds and T-bills, cash and bank balances, and cash equivalent with them. But for existing companies, what you define capital requirement as is you define it as the share capital, the share premium, retained earnings, contingency reserve, and any other admissible asset, subject to approval of the commissioner. So, and those are the issues that are dealt with in those areas in the Finance Act. And I'm sure that we have seen that all these things which were highlighted by Professor Godwin Oyedeokun, has been simplified there, and that those are the major changes as identified by me. Thank you very much.
Thank you, Dr. Sonny, for that. You've really done a lot in the short time. I know you still, if we give you more time, you'll talk more. You're pressed for, but we are pressed for time. It's very loaded. Finance Act 2021 is very loaded. In fact, for every Finance Act we take, is usually loaded. I want to recognize the presence of Alhaji Azeez Alatoye on this call, Dr. Mary Salau and Dr. Kehinde Odusi, we recognize you're on the call. Thank you, Dr. Sonny, for that presentation. I would want to quickly go into question and answer time. Please let all questions be put in the chat box so that we can maximize the available time. So, and I will allow our panelists to talk as we bring up the questions. The first question we have here is talking about, kindly confirm what the new procedure is following the deletion of provisional tax. I think I've done a response to that, but I would just say that my own little understanding of Finance Act says that we all have to do self-assessment. But I don't know if Mr. Albert would, Folorunso would just want to confirm that. I think that is just now everybody's self-assessment. Mr. Folorunso, am I right?
Yeah, I agree with you totally. I mean,
Okay.
there's nothing to add to that.
Yeah, thank you, sir. We have another question here. I need clarity on educational activities, paying tax in the Act. Does this mean schools will now be subject to tax? Let me allow Mr. Folorunso, I think he spoke about CETA. Maybe you can just help us to clarify section 23, the amendment, how does it affect educational institutions? Thank you.
All right, like I said, it remains a little bit controversial because the expectation is for those institutions to pay tax. I mean, from the way we have seen the amendment by the National Assembly, their hope is that those institutions will pay tax. But again, if you look at those institutions, depending on the way they are set up, okay, if you take a typical university, you know that they have the venture arm. Those ones, whatever they do that is related to business, they are not exempted from tax. But of course, the core academic activity of school fees and providing tuition and all that are not their venture arm. It now depends on how those institutions are set up. Are they set up as a non-profit organization? Are they under a trust deed with a trustee to manage them who are not taking benefit? Are they a company that is limited by guarantee? Okay, if all of those are present, then they ordinarily should not be liable to tax, regardless of the amendment, the removal of educational in subsection 23, subsection 1C. That is my take. I know there are people that have spoken with me to say that the basis for the exemption was that educational, and therefore going forward they should be liable to tax. But I'm not sure that is the what the federal government will want. So if there is a need for a further amendment, I'm sure it will be done because if you take a typical university, particularly those private universities, and look at the level of investment and look at the payback period, you will agree with me that it's not they are not set up to make profit per se. Okay, those schools set up, most of those schools, they are not set up to make profit. Those religious organizations, private individuals do not set up those institutions for the purpose of making profit. They are set up for as a institution of a public character. And when you say public character means the promoters, the trustees must not be sharing dividend. They must not take benefit from the school. As long as they don't take benefit from school, they shouldn't be liable to tax. But I'm sure the lawyers will definitely have to be involved in interpreting this particular amendment. That's my take for now. Thank you.
Thank you very much, sir. This question would go to Professor Edokun. Good morning. My question goes thus. News flying around from the new Finance Act is that FIRS is, sorry, let me just, is that FIRS is now empowered to plug in a tax software into the company's IT core applications for the purpose of assessing appropriate withholding tax. How realistic and legally binding on private companies is this provision? Professor Edokun, please. Prof.
Can you repeat that question again so that I can just...
It says, news flying around from the new Finance Act is that FIRS is now empowered to plug in a tax software into the company's IT core applications for the purpose of assessing appropriate withholding tax. How realistic and legally binding on private companies is this provision?
Okay, thank you. Let's even leave the issue of news and let's treat the issue of the power of Federal Land Revenue. Whether or not you plug in their system to yours, if provisions of relevant law there says that they have access to, they have power to assess, investigate, examine, it means they have ancillary powers to use a legal means of assessing you, getting into you. Okay. Another thing is, would they have capacity to do so? Okay. In different crimes, in our studies, especially for those of us that study with CISA, we know what we call ODBC, where you can have your database management system interfacing your system as auditor to that of the auditee, whereby all they need to do is to plug it to your software and it will mimic and mirror it to theirs, and your system is still intact and they will be able to get patterns. So it's possible, and I don't think it's very illegal, no matter how the rumors may be. So it's going to be new thing, and it may not be something that can be so quickly to be done, because even the capacity they have now on their task force, Max, we are still rigiding it, and I think it's possible to be done. It's not going to be illegal, whether it is accommodated now or whenever they are coming. And look at the provision that we talk about, that they can now deploy system. They also have powers to engage third party to do so. I hope that is what the questionnaire is asking.
I think Dr. Sonny wants to add. Okay. Yes, sir. Go ahead, sir.
Yes. Thank you, Dr. Titi. You know, the question asked, the answer is already there in the Finance Act. Talking about legality, the legality is there. Section 25, subsection 4 has already given the right to FIRS to deploy, proprietary or third-party technology to organizations. And even there is a penalty. The penalty is in subsection 4B of the same act. The penalty is if you refuse to allow the FIRS to deploy this so-called technology, then of course you are going to be fined 50,000 for the date that you refuse, and 25,000 initially, and 25,000 for every day that you refuse. In terms of if it is practicable, I tell you, it is highly practicable. The question is, will FIRS want to deploy technology for all private firms in Nigeria? The answer is a no, right? What I see FIRS doing is maybe using the Pareto analysis, the 80-20 rule, right? They are going to be deploying this technology on institutions, on organizations that generate a large amount of revenue, right? That they get a high tax revenue from, right? And with that, the resources to be deployed, I bet you they are available. The manpower, I bet they are available, because ordinarily, why was this injected into this Finance Act? I'm sure it was FIRS and that muted this idea, because they believe that it's a veritable way to increase the revenue generation drive of the service. Thank you for that.
Okay, thank you very much. Okay, sir.
Okay,
Yeah.
so I think the question is very straightforward, which is can FIRS plug in technology to deduct withholding tax automatically? And the answer is no. You still have to file your return online within 21 days after the end of the month. But what have we seen FIRS done, and what are they likely to do? They have deployed technology in several institutions, in the shopping mall here and there. And what do they normally do? It is to ascertain specifically how much is due. It's not that they will just do it automatically, and as you are carrying out your transaction, your withholding tax is being deducted. No, that is not the type of technology that is being deployed, and that is not what the law has allowed. Okay, those technology will be deployed to be able to track. For example, if you go to a bank at the end of the month, they'll be able to ascertain how much VAT they should remit, how much withholding tax on interest they should remit. All those things will still be accumulated by the banks, by the companies, by the institutions, and then be remitted, through the tax promax at the required time at the end of the month within 21 days. Except those ones are removed, you cannot be doing auto deduction. But of course, those technology will allow the FRS to be able to track, to be able to ascertain the expectation and the exact amount that such a company should do. And that is what they are presently doing if you are close to the FRS on some of these things. Thank you.
Thank you. Before we go into further questions, permit me to quickly recognize Chief Chibuzo Anyaechi, FCA, Council Member, ICANN, and also Alhaja Fasat Oguni, FCFCTI, Group Lead, FIRS, for coming on the webinar. You're welcome, sir and ma. So I'll quickly go to another question. We have quite a lot of questions here today. I don't know if we can take everything, but let's see how far we can go. Dr. Sonny, this is for you. Kindly educate me. Whose responsibility is it to bear the burden of CGT on sale of land, the buyer or the seller, in this case, government? A particular state charges CGT on sale of land, but lays the tax burden on the buyer that goes to register such land to acquire C of O. So can you please help us to intervene on this? Dr. Sonny.
Yeah, I didn't get you. Sorry, I lost you a bit.
Okay. The question says, whose responsibility is it to bear the burden of CGT on sale of land, the buyer or the seller? In this case, government. A particular state charges CGT on sale of land, but lays the tax burden on the buyer that goes to register such land to acquire C of O.
Yeah, the CGT, if you look at the concept of CGT, the CGT basically is applicable to the appreciation on the value of land that you have acquired over time, and at the point of selling it, of course, if you bought it at X amount, it is now Y amount now, right? So there's a capital appreciation on that particular land at that particular point in time. So it's on that value that you are paying the CGT on.
The question is, who bears the CGT, buyer or seller?
Of course, the person that bears the CGT on the face of it is the seller, because he's the one who already who owns the asset and is selling to someone, and the capital appreciation is the one who has gotten the capital appreciation on that on the property. But what the government does apparently is this: by the time you, as the buyer, you want to register your title, you want to register your interest in that particular property. What they actually do, if you look at the computation that they normally give you, you find out that they look at you are supposed to even submit the details of the seller of the property, right? The details of the seller of the property, and the tax that they even collect, the taxes is on both the buyer and the seller. So, but the approach that the Lagos State government does now is, of course, because they know that they can't find the buyer after the seller, they can't find the seller after the buyer has actually purchased this particular asset from. So the burden must be on somebody. So, but because you need the title, of course, you can fight it. But unfortunately, because you need the title, whatever payment they need you to make, you have to make it for you to get your normal title.
Okay. Mr. Folorunso, do you want to add, Prof, or whoever wants to add anything?
Okay.
To say?
So we can see the anomaly in the administration of capital gains tax all over the world. So Nigeria is not different. But of course, so when you dispose of assets, you are not likely, which should ordinarily happen in other climes, you are not likely to inform the tax authority. Individuals should actually be filing capital gain tax to say that I have disposed my assets which are acquired for CGT to the what the tax authority have adopted is to perfect title to the document, I mean to the land. And so when you come forward to perfect title, you are made to pay the CGT. And of course, since the cost may not be known, we're only looking at how much you have acquired it.
Sorry, please, can we all be on mute?
All right.
Okay.
So since the cost may not be known, you will observe that even in Lagos State, they do not apply 10% on the value you are trying to perfect. On the value you have acquired the asset. They apply 5%, and that takes into consideration the fact that there is cost element. That also takes into consideration the fact that there are some element of inflation, okay, which will have made, but we don't have indexation allowance in our law, and that is why they have adopted that approach. So the correct answer is that the person responsible for paying CGT is the person that have made the gain, which is the seller. But of course, since the seller cannot be seen or cannot be tracked, the person perfecting title is made to pay such a tax in Nigeria.
Thank you very much, sir.
The authority for adopting that approach.
Okay, let me quickly go to, I think I have questions here that borders on the police tax. I'll take that before going to other questions. There's a question that says, is Nigerian Police Trust applicable to all entities? And the second question to that, that looks like it says, the FRS have not come up how to calculate Nigeria Police Levy. The act enacted in 2019 imposed tax on 0.05% of net profit of companies operating in Nigeria. So is it accounting net profits or tax profits? So those are two questions related to police trust. I don't know.
Okay, yeah, I'll take it. First of all, the Nigerian Police Trust Fund Establishment Act, right? That's the section 4, subsection 2, specifies the rate of the levy, and the rate of the levy is 0.005% of net profit of companies operating in Nigeria. That's what the act says. And the Nigerian Police Trust Fund Establishment Act, which was passed into law in 2019, is supposed to run for 6 years. It's supposed to run for 6 years. And after 6 years, of course, they probably they want to extend, or probably the life expires. But it says for companies operating in Nigeria. So there's a little bit of ambiguity. Now, you say, the companies, is it limited liability companies or is it all entities? But in the act, it says companies operating in Nigeria. And like we said, in the other act, FRS has been given the power to collect any form of taxes. So this particular police trust fund will be collectible by the Federal Inland Revenue Service. The question is, people say, they've not even started collecting that levy. So how will the lifespan, which is 6 years, does it start from the period of collection, or it starts from the point when the act is established? And my position is very, very clear, right? Of course, it will start from the time the act was established, which is in 2019. And by the time FIRS is ready to collect this particular levy, I can tell you, of course, they will do back duty. So they will go back to the years. Of course, they will compute from the years that, of course, the levy was supposed to have been collected. But it is 0.005% of the net profit of the company. And when you say net profit, of course, that is very clear. That's more like accounting profit.
Okay, Mr. Folansho, please help me to shed light on this. I'm a little bit confused as to when it becomes effective. Would there be a retrospective enforcement and imposition, or imposition only commences now that the Finance Act has been signed to law? I'm aware that some companies have been making provision in their accounts every year since the law was enacted. Does it mean that they should forget those provisions and just start from now, or they should go and pay all what they've provided in their books? Thank you, sir.
Thank you very much. It's a sunset provision, which means it has a start and expiry date. And the only obstacle has been which authority to collect. Quite a number of companies have made provision for the police trust fund, which is 0.005% of profit, which is another confusion. Some people have asked, is it profit before tax or after tax? But of course, we should know that it is supposed to be profit before tax, 0.05%. So for me, being a sunset provision, just like the one we have for bonds and all that, the period is specific by the law, and it has an effective date. So, like Yemi has said, it's most likely that you may have to remit for those prior periods that has expired or for which you have accumulated and not remitted. It's very tiny amount, and I believe that people would prefer to pay it on their prior year profits as opposed to their current profit. Okay, so the provision is specific and it's sunset, so it should be allowed to flow based on the provision of the law.
Okay, I'll take two questions together, and I'll leave it to the three members of the panel to take it and give us insight. The first one says, please, I need clarification on the taxation of companies engaged in educational activities. Does this imply the organization registered as NGO engaged in educational activities will now be paying taxes? Second, I know we've answered that before, but just a short answer to this question will suffice. Second one, CETA amendment, vis-a-vis NEPSA Act 63 of 1992, especially section 18, subsection 1A. Who should comply with provisions of CETA, enterprise in the free zone or buyers on the products of free zone enterprise? Same goes for oil and gas free zone. So those two questions, one is saying, are we saying that with the amendment, NGOs will now start paying taxes? The second one is saying for free zone enterprise with this amendment, is it for the free zone that should comply or the buyers of the products of the free zone enterprise? So Mr. Abba, do you want to go give the first shot while we listen to the others?
Okay, thank you. On the educational activities, like I said, I will always say it is controversial because only God knows why the National Assembly decided to delete the educational. But the real impact is that if we look at the intention is that they want the educational institution to be subjected to tax, whether it is NGO or not. Okay, that is the real intention. But there are militating factors, which is the fact that ordinarily institutions set up as limited by guarantee or as under a trust deed with trustees who are not taking benefit are ordinarily not liable to tax. So what we need interpretation for on this is for lawyers to tell us whether on the basis of this exclusion of educational, those non-for-profit organizations will not be liable to tax. It is debatable, and I cannot give you a categorical answer to that. But when it comes to the free trade zone and all that, okay, so it is the institutions that are, registered within the free trade zone, okay, under the NEPSA Act and the OGAIF provision that are, exempted from tax as long as they don't operate into the custom territory. Okay, anything you sell based on the 2020 Finance Act into the custom territory, you will be subjected to tax, and that is why they now require them to operate, to file returns. The way it operates is that such companies are expected to be engaged in export and not selling into the Nigerian territory, into the custom territory. When you are selling to the custom territory, you are not really, trying to achieve the objective of setting up a free zone. Why are you there for a free zone? You are assumed to be a section that is more or less detached from Nigeria. It's as if you are a separate territory on your own. And therefore, you should be selling outside of Nigeria. If you sell into the custom territory, you will, as a company liable to, as a company that is registered in the territory, be liable to tax. So therefore, if you are outside the custom territory, sorry, if you are in the custom territory and you are supplying entity within the custom territory, or you buy from them, automatically you should be deducting withholding tax, because it means that whatever they are selling into the custom territory is they are liable to tax on those transactions. And therefore, you that is dealing with them, buying goods that are imported from because you are importing outside of the territory into the Nigerian custom territory, then you should be liable to tax. We know that the authority have always guided them, and so there will be, I know there is an ongoing engagement by FRS with those authorities. So we would like to see how that goes, and what regulation or guideline that will be issued that will guide the taxpayers on what to do exactly. Thank you.
Thank you very much, sir. There is a one-line question here. What was the implication of the Amendment to Insurance Act? Is Prof still on? Dr. Sonny, would you want to just take that? Implication of Amendment to Insurance Act, any implication?
I thought Yemi took it.
Yeah.
So, you know, the insurance companies were required to show up their share capital. And so what they have, what this amendment has done is to redefine what constitutes their capital requirement. You know, by taking into consideration their retained earnings, their premium, which also form part of the shareholders' fund. So it is just to redefine, to ensure that the capital requirement is not limited to only share capital. Okay, that it also constitutes, even though we know that NICOM is still questioning even the way it has been concluded, because NICOM is of the view that what we wanted is for insurance company to bring in more funds to be heavily capitalized, so that they'll be able to take on more risk, but not just to redefine what constitutes their shareholders fund and say they have recapitalized. That is still ongoing, but the law has been signed for now. And if NICOM is unhappy, they can issue, just like CBN, issue guidelines to the insurance companies that they're supposed to oversee. So that is just the aspect of the Insurance Act that has been amended. Yeah. Just the redefinition of what constitutes the capital requirement.
Okay, thank you. Just a very short question also. The banking returns that you mentioned, is this applicable to microfinance banks also? Are they exempted, or they also have to, all banks?
It's all banks.
Okay.
And it's a quarterly return. You know, before it was monthly, now it's quarterly. And the penalty too is a quarterly penalty. And I think it's about 1 million. So for each month that you fail to do that.
Okay. I have a question here. I don't know if Prof is still on. It's on the finance.
Can just add to that?
Yes, go ahead, sir. Go ahead, sir. Oh, I think you're frozen. While we wait for him to come back, let me just quickly.
Okay, so I wanted to just add the fact that I hope you can hear me. The fact that
yes,
the
we can hear you now.
Is on return of new customers. Return of new customer. Can you hear me?
Yes, sir.
Return on new customers. Because if there's a need for them, for you to inform bank of, I don't think Yemi mentioned the issue around threshold. No.
No, I think I mentioned it. It's for individuals on 5 million and corporate of 10 million. So, and they are supposed to send their names and addresses of those new customers.
Okay. Thank you. Thank you very much. Participants, please put in your number, your name, and your membership number, especially for those who are ECAM members, for your credit hours please put it in the chat box so it can be registered. Now, there's this question on Finance Control and Management Act. I don't know if any of our panelists want to attempt this. It's a very long one, but I will see if I can just summarize it. It's talking about some inconsistencies in the introduction of a new subsection 1, new subsection 1A and B, and some other reference. But I think maybe what I would just do is to probably refer this to the panelists. It's a bit long, and I don't think we can have the time to read through because it seems to be talking about ambiguity. It says Section 29 of Finance Act 2021 amends Section 4 of Finance Control and Management Act by introducing a new subsection 1 and inserting new subsection 1A and 1B. The new subsection 1A requires that all monies collected on behalf of Federation by any agency must be remitted gross to the CRF or relevant specific special purpose accounts without any deductions or payment. Subsection 1B seeks to strengthen the requirements in 1A by introducing penalties for violation of the requirements in 1A for any person who pays or authorizes any payment before remitting the balance to the collection of government to government. However, the insertion of the phrase fails to, in the third line, appear to have given the opposite meaning of the intention of the law. In my opinion, the said phrase has no place in that subsection, while else should be deleted, to be added to the words pay and authorized in the fourth line. Please help clear the ambiguity in subsection 1B. Now, this is a long one. I don't know if any of our panelists wants to talk about it. Otherwise, we'll send the response to whoever is asking this question.
Yeah, majorly what the Finance and Control Management Act is trying to do is to ensure that any money that is due to the coffers of the government is remitted gross. You know, we have a situation where maybe ministries appoint agents, and in appointing agents, they have maybe it's like a performance-based arrangement wherein they have a percentage of the money that is generated, right? So most often times, the amount generated and the amount remitted to the coffers of the government, I think is usually on a net basis. So I think this is what that is trying to address. And also, most often times, total money generated, which was the establishment of TSA, so that whatever money comes in, it goes into TSA account. A lot of times, account monies are received into an account before it's now remitted into TSA. And when it's remitted into TSA, it's remitted net of maybe the commission due to the agent that are. So this is what this is trying to guide against, that all money collected must be remitted gross into the coffers of the government. So that's majorly what this act is, what the Finance Act is trying to do by the amendment to this section 4 of the act.
Does Prof want to make any addition, or it's been covered?
Yes, that is adequately covered, but I only want to add that I don't think there is any major issue there. Public financial management is very clear. If all these are not there, people will explore the loopholes in such arrangements as said by Yemi Soni and defraud governments in a manner that is not in our collective interest. So I think we can still make do with this for now. Thanks.
Okay. I think I can see hands being raised in terms of but let me quickly finish with the last one. Might just give few people. I don't know if I have the permission of the chief host to take this for the next 10 minutes, the question before we wrap up. So there's a major question here that talks about constitutional mandate of RAMFAC. It says that the act overrides the constitutional mandate of RAMFAC, which is listed in section 153 subsection 1 of 1999 Constitution as amended, with clear mandate in paragraph 32 to the third schedule to monitor accruals to and disbursement of revenue from the Federation accounts. Can an act amend the constitutional provision? Prof, I think I will want to start with you on that.
Okay. Generally, I will answer to the position of law. Why I will appreciate Federable to talk, because I've listened to him talk about that. Now, we need to be careful with this issue of our mindset when it comes to invoking section 131 3C of the Constitution that anything that is not consistent with the Constitution should be no. We should be careful in applying such. Majorly, no act we have power to alter Constitution except constitutional acts. Because if you look at what is going on in the National Assembly now, even when they want to amend Constitution, you see constitutional amendment and it's now in piecemeal. I don't think that is the intention of this session. The same issue was discussed under the power given to the minister in charge when it comes to the issue of accounting, imposing of taxes under the stamp duty, section 27. So, acts cannot override Constitution, but Constitution has given some power to some certain arms of government to do certain things. If they explore that to their fullest, they have not contravened any law. Thank you.
Also, Madam Titi, also the Finance Act does not even go against the constitutional mandate of RAMFAC, right? The person who asked that question should go back and actually look at what the mandate of RAMFAC is actually. The mandate of RAMFAC does not include the collection of taxes. Now, what this Finance Act simply try to correct is that anomaly in RAMFAC's mentality to think that they can go in to collect taxes. They can actually, what part of the mandate of RAMFAC is to go and check and ensure that the amount that is due to the coffers of the government is remitted into the coffers of the government. Where during their investigation, they find out that there's an amount that should be have been remitted that has not been remitted, or by virtue of the fact that an investigation was not carried out properly, they are to refer such case to the agency responsible for the collection, which is FIRS. And that is what the new Finance Act has just come to clarify. You understand? So that, you know, everything is clear. They can go in, do their duties, but they do not have the power to collect taxes. Like people that are in practice will know, we face this with most of the audit that RAMFAC goes to do. Once they carry out that audit and there's an exposure, you will find out that they slam them and they tell them to come and pay. You find that the account they are paying to is not even FIRS account. And this is the anomaly that this act, this Finance Act is going to correct.
Okay, I don't know if Mr. Franco has anything to say on that before we take the last question.
The only thing I would say is that if RAMFAC is unhappy with the provision, they should go to the National Assembly. I would say here we are just gisting.
Okay.
We cannot do anything about. We cannot do anything about constitutional matter on this platform. Thank you.
Yeah,
we are not comfortable.
Sir, I have a question on Promax, and this will interest everybody. Since FIRS have deployed the tax Promax, have all exemptions, penalty computations also be programmed in line with these amendments?
I think you have used this and you have been informed from. Can you just also help us answer that?
I would say that from experience, Promax has some penalties, like your late filing, like your VAT late payment. As you put it in, it will calculate and give you. And the bad part of it is that it calculates on daily basis. So if you like, put 2 days, it will quickly calculate for you. But with respect to the new penalties, which is in Finance Act 2021, I guess this is going to now be amended, if need be, on Promax. But as Promax is it today, based on experience, there are some level of penalties that once you put in, even on your TP plat, which is for the TP, it gives you your penalty, and you will not be able to even to get your tax clearance once those penalties are triggered until you clear them. So that's, I don't know if there are other additions from Mr. Folorunsho and Sonny.
Well,
but that's
for me, if you look at the current Finance Act, there are not routine penalties that you think will be automatically amended on the Promax. There are specific penalty for failure to file returns by banks, failure to allow the FRS to deploy technology. These are specific one-off penalties. They are not ones that you need any amendment. Whatever you have on the Promax now will continue to run, while these are just imposed penalties, depending on who has defaulted in compliance with the provision of the law.
Thank you very much. I don't know if I have my LGM, Toby Abiola, if he wants to say anything on that, because I know it's his territory. Any comments, sir? I believe Promax has been positioned to take all the penalties.
Yes, it's a software development that puts in, and it's something that can be corrected or amended to fit the terms of today. So once you file your response, it will come in line with the new provisions. Thank you very much.
Thank you. I'm not sure if I have any hand raised. I've taken the questions on the chat box. So we have any hand raised for any question we can take, but I can't see any hand. So I want to believe that. Okay, I can see one person, Peter Adebayo. Oh, sorry, we have a very short time, so I only take these two that I've seen the hand raised, only these two. Peter Adebayo, can you please, if you can, unmute and then ask a question.
Thank you very much. I really appreciate the privilege. My question is, even though I have not taken time to also comprehensively look at the Finance Act, I want to be able to find out the position of this Finance Act on the controversy that trailed the legality of collection of VAT last year, 2021. I don't know whether that has been addressed by the new Finance Act. Thank you very much.
Okay, thank you. I would want to start with Mr. Folorunsho and then other panelists will intervene.
Should we take the questions?
No, I think it's the only one I can see is hand raised.
Okay.
Yeah.
I saw somebody else.
Yeah.
Of course, the controversy around VAT is not something any finance actor can address. I'll show you.
This is constitutional issue.
Okay, it is a constitutional issue, and it is beyond the finance. Is beyond the Finance Act, and you will see that because of that ongoing controversy, there are limited amendments that have been made to the VAT provision. Very limited amendment, which is specific to cross-border transaction, which any which way may still be under the purview of the Federal Revenue Service. So anything that has to do with the subnational having to raise issue, or that would suggest that the federal government is trying to make provision that will circumvent the rights or the territory you will observe that all those have been quietly and carefully, avoided.
Okay.
And so it is not something that can be dealt with under the Finance Act to run its course, and then they will take it from.
Okay, thank you, sir. I have Adeyemi. Hello, sir, are you done? Hello, sir, are you done?
I'm done.
Okay. I have Adeyemi. Adeyemi, can you just ask a question?
Good afternoon. I sincerely appreciate the organizers of this program. My question is on the tax. I had the response of Dr. Albert on respect to the issue of penalty and interest. As of yesterday, we still log in from our office here, respect to a client. We still realize that apart from the LRP, there's still the daily interest and penalty as at yesterday. I don't know what FRA is doing about that, because this might be this will not be encouraging to even taxpayers. And I think the purpose of the Tax Pro Max, yes, in time encourage encourage revenue to the government. So I want to say this issue of daily interest and penalty, they need to look into it, because we are in a new financial year. Thank you very much.
Thank you.
Is the law or something? I don't know.
I'm not saying it's against the law, but the issue of daily, because by the time you print it out today, if you are not paying today, you still have to print it tomorrow, because it calculates the interest and penalty on daily basis, apart from the LRP or late filing. That's what I'm saying. I think it's a difference to the previous method we are using. Thank you very much, sir.
I think when we're hearing from LJM, Toby Abiola, I mentioned the fact that they look into this, but I want to believe that if you have outstanding liability, that's when the issue of penalty interest computation will take place. If you don't have outstanding liability or amounts to be paid, then I'm not sure to be calculating any other thing. So I want to just believe that is the matter that is happening, unless Mr. Folorunshon wants to say anything on that before I call the last question for this for today.
Okay, please check Sule Olawole. There's something he posted some times ago. If you have to check it.
I think I've picked almost all the questions that I have there, unless it's posting again.
Okay.
Yeah. Then Abdullahi Aliu, you can raise your question, and then we'll close. That'll be the last question for this webinar. Abdullahi Aliu.
Good afternoon. Good afternoon, ma'am. My question goes to Mr. Albert Folorunshon. I want to get a clear explanation or definition on the amendment of Section 30 on assessing non-resident companies of 6%. I heard him, you were saying that those that have PE, that they need to file actual account, and FRS may go back to apply the 6%. I'm somehow not clear, because I think the agitation of getting a specific rate for them is because of the complexity of those non-resident digital services providing those informations, because they have offshore or head office expenses that are heavy for us to clarify and get the true position. So I'm confused somehow if you are saying they should file account, because they all have virtual PE by the virtue of the fact that they have 25 million and above in Nigeria. So I want to get that clarification. Are they filing actual account, or we are applying the 6% on them? Or you are just, the way you are, the file account, then we revert back to 6%. Please, I need that clarification, sir. Because the other category, those that are providing professional, technical, consultancy and management, they have 10% withholding tax, no need to file account. So please, Mr. Folorunshon, I need your clarification. Thank you, sir.
Thank you very much, Abdullahi. That's a very good question. And I have opened in front of me Section 30 of CETA. And Section 30 addresses both, I hope you can hear me, addresses—
Yes, we can hear you.
Both Nigerian companies and non-Nigerian companies. And under the non-Nigerian company, it only included a subsection 2A to capture companies that are engaged, non-resident companies that transmit, emit, receive signal, sound, messages, images, cable, and all those non-resident entities that are into electronic commerce. Majorly, you can mention Amazon, you can talk about Zoom. I don't know whether Twitter is eligible now and all that. So those are the companies that are under focus by this amendment. But the original provision remains, which is turnover assessment will be applied where, one, a company does not have an accessible profit, the accessible profit cannot be readily determined, and three, where the accessible profit determined is below what is expected of such a company. Where those three conditions are met, okay, the company may be assessed on a turnover basis on a fair and reasonable percentage as may be determined by the relevant tax authority, which is the Federal Inland Revenue Service. So that is the existing provision, and that remains the provision. If Nigeria is going to adopt a flat percentage on turnover, it will be very clear, which is called Digital Service Tax, DST.
DST.
In most jurisdictions. Nigeria has not adopted DST, and we should ensure we clear that air so that those non-resident entities will know. A lot of them have been calling that where is 6% coming from? Okay, some of them are already reviewing, their transaction, and whatever DST that is adopted will be passed on to the Nigerian customer. If you adopt 6%, if I'm buying any book on Amazon now, that 6% will be added to me straight away. Okay, and that is not the intention of government, and that is not what has been done. What has been done is just to say that I know since the adoption of significant economic presence, they are required those companies to file returns. The returns are being filed. There have been complaints to the extent that the profit, the effective rate on their turnover for some of them is 0.0%, point whatever percentage, which is being considered very low as far as Federal Inland Revenue Service is concerned. And that is why they have said, okay, going forward, we may have to be, we may have to drag any of those entities who we consider the results to be unreasonable under this provision. So it is not a blanket adoption of a DST on non-resident entity. I hope that is clear, Leo. And I think that message is for you to sell, because you are the head of non-resident companies. If you sell DST, you will see company run away from you. Okay, so let us sell what is in the law, which is turnover assessment may be adopted, at the discretion of the authority. Not that there is now a flat percentage of 6%. The minister mentioned 6%, somehow, but there is no 6% in the law before now, and 6% is also not included in this current law. Not adopt what is not in the law. Thank you very much.
Thank you very much. I think we've really spent our time. We've had robust discussion. The questions have taken us into a lot of mind-blowing issues in the Finance Act 2021. While some will feel government is collecting more money, some will feel I have more obligation. Some will say I have more money to collect from my clients. Some will say I have more financial management for my clients. And I can see that everybody is going to pick their own. And some will say I'm now more empowered for tax administration. Finance Act has addressed everybody. And I want to believe that staying on this webinar is a time that will be well spent. We've not wasted our time. We've added value to ourselves. And it's a good thing we are starting this year. I would want to quickly call on the chairman of FSB chairman, to give the vote of thanks. But before he does that, let me say, panelists, you've done well, and you really made my work easy. Participants, you've done well, and you really made me to feel good having the type of questions that are coming up on this platform. Over to you, sir.
Yes, thank you very much, Dr. Titi for welcome. Can you hear me?
Yes, sir.
Okay, thank you very much. And standing on the existing protocol, I want to appreciate everyone that has been a part of this webinar. This is the third in the series of our annual Finance Acts webinar. In 2019, before the advent of COVID, we were able to do it physically. We hope that one day we'll be able to do it physically once again, and we'll put a physical touch to this. But be that as it may, we're just going with the flow, and we'll be doing the webinar series as time goes on. I want to appreciate the lead doyen and the chairman of the GMI Council for his support and presence. I want to appreciate the guest speaker, our own Professor Godwin Oyedokun, for delivering the main paper. I want to appreciate Mr. Folorunsho Albert and Mr. Yemi Sonny for being part of the panel and sharing with us their wealth of experience and knowledge. And of course, I want to appreciate the moderator, Dr. Titi Fawokon, for steering the ship of the program. I want to also appreciate the members of the GMI Council, the GMI General Accountants Management Group. I want to appreciate all ICANN Council members present, all CITN Council members present, and especially to you, our professional colleagues, for taking time out to be a part of this webinar.
I think there's FRS chairman on the call. There's FRS chairman on the call, please. FRS chairman. Yes, he's on.
That means we need to listen to him. If he will talk to us, if he's in a position to talk to us, we want to at least hear him say a few words. Please, let's confirm before we close if he will be in a position to talk to us.
Please, can we just identify our FRS chairman, Mr. Nami? LGM Toby Abiola, can you identify him for us, please?
Okay, please hold on. He'll join you shortly.
Okay.
Okay, thank you. We will wait. We wait. This is really a very special occasion for us, having the FRS chairman in our midst. We actually thought that because of his busy schedule, we didn't want to bother him. Okay, I think he's here. You're welcome, sir.
Hi, chairman, sir. You're welcome, sir.
Madam,
Good morning, sir.
Sir, you have the floor. We would like to have your comment, just a few comments from you. We can't afford to have you in our midst and not hear your voice, sir.
Oh, thank you very much. That's nice of you. Thank you, distinguished ladies and gentlemen. I must personally recognize the ICANN president and some of her members, particularly the stubborn ones on the finance policy reform committee, the likes of and some of them that I may not know that they are on call. To appreciate them so much for that which they are doing for this country, because that committee seems to be a very small one, but seems to be one of the most strategic committees today that we have in Nigeria. That which we want from them, 100 over 100, we are not able to achieve that yet. But with the little they've done for us, I think particularly in the area of power, given to everybody to deploy technology for tax administration, we cannot thank them enough. We still have issues that we sort out in-house when we meet with them one-on-one, but you shouldn't be surprised that some of us will fight them to the extent that we'll even give them back the power to automate the tax administration process and say we prefer some other issues that we want you to consider, to be considered first. One of such issues is that we're able to make it possible for Nigerians, particularly the investors who are already paying taxes, to continue to do so without necessarily facing certain issues of increasing rates at this very critical point in time. What we want to do going forward is to see if Nigerians will give us that support so that those indirect taxes that they collect on behalf of Nigerian government, they remit that as at one due so that we on our own side fight for them so that the income tax or the direct tax rates are reduced in the near future. And for the power to automate taxes that you have fought for us, we appreciate it because with it, we are now able to do tax administration simultaneously using technology, from tax filing, from tax audit functions, from taxpayer education to issues surrounding handle litigations in court that we can now do using technology and all other things. The very important one that I want to mention is our ability now to seamlessly exchange information with other jurisdictions on taxpayers and the activities of the taxpayers in those jurisdictions. Capacity building is another key one that I feel I should also bring to the notice of the members and those that are on call, that with technology now we're able to build capacity without necessarily bringing staff together to say, let's listen to the facilitator. We're able also to able to disseminate information seamlessly. We have recently launched our contact center, and with the help of technology, people no longer have to visit us physically to be able to ask questions or make inquiries on what we do. So these are few of many things that they are doing for us, and we appreciate it. And we appeal to that they continue to support FRS so that going forward, we are able to mobilize revenue from all sectors of government, particularly now that virtually everything that people do, they use technology in doing it. And without that power to automate the tax administration process, we'll not be able to have access to taxpayer information, taxpayer data, for us to be able to police them for purpose of tax mobilization for the 3 tiers of government. So thank you very much for the opportunity. I wouldn't want to take much of your time. I appreciate the little time you have given to me. Thank you.
Thank you, sir.
Yeah.
So thank you very much, the chairman of the Federal Inland Revenue Service, for honoring us with your presence. It's really come as a surprise to most of us, even those of us who are on the organizing side. We really appreciate that gesture, and we hope that we keep up the link and the relationship, so that subsequent times we will know that you have our back, and we can always move forward. Once again, I want to thank everyone who has patiently been part of this webinar, and those of us that are here even up to the last minute. Now you have seen that the patient board hit the largest bone. So thank you very much, everybody, and God bless you all.
Thank you.
Thank you. So we just have the GMI anthem. And we have the GMI anthem to close the webinar. Let there be love shared amongst us. Let there be love in our hearts.
Let there be love shared among us. Let there be love in our eyes. In your love, sweep this nation. Cause us, oh Lord, to arise. Give us a fresh understanding of brotherly love that is real. Let there be love shared among us. Let there be love. Let there be love shared among us. Let there this nation, cause us, oh Lord, to arise. Give us a fresh understanding of brotherly love that is real. Let there be love shared